The first half of 2020 was a period of high volatility for equity markets, with declines of over 40% at one point, before a very strong recovery in share prices left our underlying investment portfolio around flat at the end of June from start of year levels. We made several changes to the portfolio this year, a number of which were implemented before the crisis hit. We reduced exposure to value stocks and income stocks, which have been struggling in recent years and which tend to be relatively sensitive to short-term fluctuations in the economy. We also reduced exposure to European equities on concerns over the region's response and also resilience in the face of another huge challenge through the recession brought about by COVID. We cut the number of stocks in our US growth portfolio and also in Japan, focusing in on the best ideas in these areas. These changes helped to fund an allocation to a new sustainable strategy focused on high-quality businesses globally, which are fast-growing and have sustainable business practices. Some of our holdings have performed extremely strongly over the past 6 months. In general, these tend to be growth stocks, which have proven to be resilient to the economic downturn, and in many instances, COVID has accelerated existing trends which were already benefiting many of these companies. In addition, aggressive policy action that we have seen has pushed down interest rates, and this tends to benefit those long-duration secular growth stocks. Our largest two listed holdings, Amazon and Microsoft, have delivered returns of around 60% and 30% respectively in dollar terms year to date. Amazon has clearly benefited from a shift to online retail, while both it and Microsoft are beneficiaries of moves to the cloud. In Europe, one of our preferred holdings, Delivery Hero, which is involved in online food delivery, has gained by around 35%. Some of the areas where we added holdings, like PayPal, have also performed strongly. PayPal is up by over 60% year to date, driven by a sharp rise in e-commerce. This is a really challenging time for income investors. Economic shutdown has starved many companies of cash, and we're seeing very significant pressure on dividends in a number of areas. In many instances, stocks which would have been regarded as high yielders are cutting, suspending, or cancelling dividend payments. In some instances, such as in the case of many European financials, this is forced on them by regulators. So we're seeing a sharp fall in earnings at the market level, and we'll see an unusually large decline in dividends. Normally, for every pound that earnings fall in a recession, dividends may be expected to fall between 40 or 50 pence, but the sensitivity of dividend falls to earnings declines will be much higher this time. F&C Investment Trust has paid a dividend in every single year since 1868 and has a record of 49 consecutive dividend rises. We came into the crisis with a covered dividend and high levels of revenue reserve, which means that we're very well placed to continue our long-term track record, not only of paying dividends, but of paying rising dividends to shareholders. Indeed, the board have committed to another rise in dividends for shareholders in 2020, which will be our 50th consecutive annual rise. We currently have gearing levels of around 8% on the trust, which is down modestly from starting year levels. We cut gearing levels in the second quarter after markets had rallied very substantially from the lows. Our cost of borrowing is low at around 2.5%, meaning that our hurdle rate from adding value for shareholders from our borrowings is also low. At the present time, I think gearing levels are appropriate, and while I'm optimistic, there are many risks to markets in the months ahead. Longer term, I remain confident that we can continue to add value from our gearing policy. In terms of the outlook for equity markets, I think that the recent bout of unprecedented volatility reinforces the need for investors to retain a longer-term perspective. There's no doubt that there are going to be challenges in coming months and quarters, and there's also little doubt that certain segments of the economy will struggle to recover fully from the COVID crisis. That said, at present, my expectation is the recovery in the economy will be faster than that seen in the aftermath of the global financial crisis more than a decade ago. Then it took the US around 3.5 years and Europe 7 years to regain lost output, but this time we should see a swifter recovery. In part, this is due to the scale and speed of policy response which we've seen in terms of monetary and fiscal stimulus. I expect that policy will remain supportive for a very long time, and in turn this will support equity markets. Recessions tend to reinforce and accelerate existing trends, and I expect this time will be no different. There remain plenty of good opportunities for investors, and the pace of change is accelerating. For F&C Investment Trust, the board and I remain focused on the long-term objective of growth in capital and income for our shareholders, and I continue to believe that equity markets, listed and private, offer the best opportunities for growth at present.